This is Chase McWhorter with Institutional Real Estate Inc. I'm sitting with Jon Pharris at CapRock. So John, obviously want to just start by thanking you for taking the time. We know it's busy right now, so appreciate you giving us a few minutes here.
Yeah, absolutely. I'm glad to be with you.
So first question, just to kind of set the stage. So can you just provide a brief history of CapRock?
CapRock Partners was started in 2009 when Pat Daniels and I came together during the GFC, and we have been a pure play industrial investor and developer since we opened our doors in 2009. And at the beginning, it was just he and I essentially dialing for dollars during the GFC, trying to create a company. And initially, we were focused on non-performing loans secured by industrial buildings throughout California. And then as the market matured and recovered from the GFC, then we branched into development, which is both of our backgrounds. And we've been one of the more active developers in the Southwest. And then slowly over time, we expanded outside of California into neighboring states like Arizona, Nevada, and then up into the Pacific Northwest. And then about 3 or 4 years ago, I moved to Texas to open our central region. And today, CapRock Partners invests throughout the Western United States and throughout Texas. And we have two platforms. One is a discretionary fund business that really focuses on value add properties. And the other one is on a development platform where we have built about 12 million square feet over the last few years.
Perfect. No, and that's, again, I always like to get that just for context because it obviously sets the stage for the next question. So what are you guys seeing when it comes to development versus acquisition? And then kind of, yeah, maybe elaborate a little bit, like where are the opportunities between those two vehicles that you've seen? And maybe even expand to kind of the evolution coming out of COVID where it was just, yeah, kind of gangbusters, just going crazy.
Sure. Okay. Well, if we look at what's happened over at industrial real estate over the last 5 years or so, kind of at the late teens, early 20s, and really with the advent of COVID, industrial was really the darling child for investors, and the fundamentals for industrial development really made a lot of sense. There was robust industrial demand, lots of tenants who needed more space because of COVID, and that size range varied. It was all across the board: 100,000 square foot tenants, 500,000 square foot tenants, million square foot tenants. And the leasing from 2020 to about 2023 was unprecedented. All of those years were essentially the best net absorption years in history. And what followed from that was an increase in land prices, an increase in lease rates, and as well as all-time low interest rates. So it made it for a very compelling development background. And you could see that throughout the country, where it was essentially the most under construction product in history. And today, that's really slowing down dramatically. There's obviously the macro capital markets environment with higher interest rates and challenges with construction loans. But even more important is that the demand that was pushed through during COVID really brought forward demand of today. And what that means is that leasing velocity is significantly slower nationally, and there are some pockets where it is pretty pronounced about how much oversupply there was delivered during the post-COVID years. And
Okay.
what you're seeing is different regions having different levels of stress and vacancy increasing. So in our view, there's going to be pockets and some major submarkets that are going to have rents pull back, and as vacancy continues to increase, and that's going to create more opportunities for investment. So where I look at things is say, during the COVID years, it was a great time to be a developer because of the supply demand characteristics. And moving forward, that's not going to be the case. While there might still be isolated incidences for build-to-suits or certain pockets for development, I think that over the next 2 to 3 years, there's a very compelling opportunity to be acquiring high-quality industrial at or below replacement cost. And I believe that the construction is going to continue to stay muted through all of 25 and perhaps through 26 as well.
And just to elaborate, or maybe even just to clarify on that, so would you say that through 2026 is kind of still the ripple effects of what was pulled forward in 2021, kind of the, let's say, the panic of kind of the supply chain, companies just trying to nearshore, reshore, all those kind of things, so that demand was pulled forward, and we're still going to effectively see that till 2026. Is that am I getting that right?
So in our view, for the rest of 2024, all of 2025, and all of 2026, there's going to be slower industrial construction as some of the supply overhang gets absorbed because the heavy leasing that occurred in 2021, 2022, that really pulled forward demand from 24, 25, and 26. So
Okay.
I think that the next 2 to 3 years, there will continue to be a healthy industrial market. There will be pockets of significant oversupply. And then I think that the market's going to more or less right size itself because of the lack of construction. And so what I anticipate is that at the end of 26 and leading into 2027, we'll have a very healthy industrial market again, with supply and demand in check, like it was pre-COVID.
Okay, got it. So obviously we talked about the development versus acquisition, but regionally, where are you seeing the best opportunities? Obviously, you mentioned you moved to Texas. So yeah, regionally, where are you seeing the best opportunities?
So CapRock is focused on the Western United States, every major market west of the Rockies, as well as throughout Texas. And each market is somewhat unique, although there are some links throughout. So it's really important to understand the nuances between the markets. So as an example, in Southern California, that market is still softening, vacancy is still increasing, and there is a very noticeable lack of tenant demand in many size ranges throughout Southern California. But if you go up to the Pacific Northwest, and specifically Seattle, that market did not have nearly as much construction activity as Southern California did over the last couple of years. And so Seattle, as an example, is still a healthier market compared to Southern California, where your vacancy is more in line with pre-COVID norms, your leasing activity is pretty strong, and your lease rates have stayed fairly stable. Whereas in Southern California, there's a lot more vacancy, especially in the smaller spaces, and your rental rates have come off. Now in Texas, which is where I'm now living and located, each of the 5 markets is very different. So DFW is a little bit different than Houston, which is different than Austin, San Antonio, and the border towns. What really hasn't been talked about too much is the significant overbuilding that Austin has experienced over the last several years. And that's about every product type, whether that's multifamily or office. But for what we do, industrial has been, in my view, significantly overbuilt in Austin. And I think that could create some unique investment opportunities in the coming years. And when you look at national reports, Austin is one of the submarkets that has the highest vacancy nationally.
And that's not just industrial. You're saying, what you're saying is it's across office, multifamily, everything, Austin being one of the softer markets.
Yeah, across the board, Austin seems to be one of the softer markets for all of the major real estate food groups. But specifically for industrial, it is one of the softest submarkets nationally, with the highest availability rates of any major market.
Okay. That's obviously, now I live here, so it's
Oh, you drive up and down 35 or 30.
If it happened within the last year, you know the reason.
Yeah.
Well, no, we appreciate you taking the time, Jon. Again, we like just getting kind of a snapshot of kind of the different markets. So obviously appreciate your kind of laser focus on those regions, industrial, and obviously the benefits that come with that is being able to dig in, get very granular in these markets, product types from acquisition to development. So no, we appreciate you taking the time. Yeah, have a great rest of your day, and yeah, Godspeed out there.
Right, thanks, Chase. Appreciate it.
All right.